The Federal Reserve Bank says that our economy is going to grow faster than expected this year and next year. Just yesterday, the Federal Reserve Bank met and they decided to not raise interest rates in September of 2023. However, they did say that you should expect one more interest rate hike before the year ends. Now, the interesting thing about their statement was they also said that it seems that interest rates will have to stay higher for longer than expected because it's more difficult than expected to bring inflation down. And they're also saying that it looks like our economy is going to stay hot for longer than expected. Now, the reason why they're saying that our economy is staying so hot is because people are spending money. Now, the interesting thing about this is that sometimes what's good for the economy isn't always good for you. Let me read you an article from CNBC. Actually, let me read you this one sentence from CNBC. It says the consumers, remember, rich people, poor people, middle class people, everybody is a consumer. Consumers make up about 2/3 of all economic activity in the United States, and consumers have been resilient, spending even though savings have diminished and credit card debt has passed the $1 trillion mark for the first time in a recent study by the University of Michigan. What does that mean? Well, our economy is staying hot and our economy is growing because of how strong or how resilient our consumer is. Meaning people are spending money even though you're eating away at your savings and even though you're racking up credit card debt, and that is keeping the economy hot, which is also keeping inflation kind of high because you have a lot of people buying things. But then interestingly, you also are seeing a little bit of a shift in the job market, which might be good for the Federal Reserve Bank, but not so good for you, regular people. Let me read you what the same CNBC article said. What it said is that job openings have been coming down, helping the Federal Reserve Bank mark progress against a supply-demand mismatch that at one point had seen 2 positions available for every 1 worker. So what does that mean? If you are an employee or if you're looking for a job, you want to have more job openings out there because that gives you more leverage, because now you can look for different opportunities and more workers need, or more employers need your work. Well, if job openings are coming down, that means you have less options. And that means you have to compete against more people. And that means you might have a little bit tougher time finding a job. However, this is good for the Federal Reserve Bank because according to the Federal Reserve Bank, if job openings are coming down, that means that employees won't be able to demand as much increases in salaries, which would also help to cool down inflation. This is where, again, you can start to see the dynamics between what's good for one party might not always be good for a different party. For an individual, you saving money and you investing money is good for you, but not so good for the economy, because for the economy, they need you spending all of your money going into credit card debt because that keeps the consumer resilient and that keeps the economy growing. From an inflationary perspective, according to the Federal Reserve Bank, if people are being laid off, and if there are less job openings out there, that means employees cannot be getting that same pay growth that they saw over the last few years, which means less spending in the economy, which helps to cool down inflation, because the cause or the thing that the Federal Reserve Bank is trying to fight right now on inflation is the demand to buy things. And people have the ability to buy things because, according to the Federal Reserve Bank, people have been seeing this increase in their incomes. And because people have been seeing this increase in their incomes, they have more spending ability. And if you have more spending ability, banks are also willing to give you bigger credit card lines of debt and more debt, so you can spend more. And so if people have more spending ability, now you can go to the store, buy more stuff. If people keep buying more stuff, that pushes the price of things up. So you can start to see how this is a little bit of a circular game. And in order to solve this inflation problem, it comes with pain, which can include job losses and potential less growth in job incomes. Now, generally, that less growth in job incomes wouldn't be such a big deal, assuming that the prices of things are not growing as fast as your incomes. But that's not what we're seeing today. Now, we've been covering all of this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is working to break down what's happening in things like the economy, the Federal Reserve Bank, interest rates, the housing market, the stock market, crypto, and the global economy. You can read Market Briefs in less than 5 minutes every morning, and it's completely free. So if you have not joined Market Briefs yet, I got the link to how you can join this free newsletter in the description below, or you can go to briefs.co/market. Now, going on with what the Federal Reserve Bank is saying, The reason why they are now predicting interest rates to stay higher than expected is because of how difficult of a time they are having to bring inflation down. Let me read you what Jerome Powell said directly. He said, quote, "We want to see convincing evidence, really, that we have reached the appropriate level and we're seeing progress, and we welcome that. But we need to see more progress before we will be willing to reach that conclusion." Essentially, he wants to see convincing evidence that inflation is actually down and going to stay down. Now, if you remember the most recent inflation reports, we've been seeing inflation slowly start to trickle upwards. But what he's looking for is convincing evidence that inflation has hit the appropriate level. Now, if you take a look at what's going on in the economy around you, everybody knows that the prices of things are still getting more expensive. Everybody who goes to the store and has to shop sees the prices of their groceries getting expensive and staying expensive. You don't have to be a rocket scientist to notice that, even though some of the policymakers who are making these decisions might not see that in their everyday to-day life. But in addition to that, just take a look at what's going on in the housing market. Mortgage rates have more than doubled, but you're still seeing such a hot housing market. So the Federal Reserve Bank wants to cool down this demand. They want to cool down the price growth. But every regular person is seeing the consequences of inflation. Now, one of the consequences of higher interest rates, besides trying to cool inflation, is pain in the economy. One form of that pain in the economy is job losses and pain in businesses, which could contribute to lower wages. In fact, I posted a video maybe a week or two ago talking about how many companies have been cutting the starting salaries for their positions. And the reason why is because some companies are just seeing higher costs. And they're seeing that kind of the average starting cost is starting to fall. So now they're trying to just meet demand of what other companies are paying. And so they're starting to lower some of the starting salaries. And so you can start to see now for an employee, for a person, if wages aren't growing as fast as inflation, that poses a problem because inflation is still around. The prices of things are still rising. It is expensive. Eating out is expensive. Groceries are expensive. Traveling is expensive. Rent is expensive. Healthcare is expensive. Everything is expensive. But if the economy or wages aren't growing as fast to keep up with the cost of living, well, you can start to see why that's a problem. And this is where now the Federal Reserve Bank is saying, well, it seems like interest rates are going to have to stay higher for longer. What the Federal Reserve Bank said is now they're predicting, and please take these predictions with a grain of salt because they're always changing these predictions. Every few months you get a brand new set of predictions. So just take this with a grain of salt. They're now saying that they're expecting interest rates to be at around 2.9% in 2026, which is what they're saying is above normal. So they're saying, the Federal Reserve Bank is saying that now in 2026, interest rates will continue to be above what they call neutral because that's what they're saying is going to be needed in order to keep inflation at bay. Now, the reason why this is so significant is because you have a lot of people talking about what's going to happen with interest rates. What's going to happen with mortgage rates? And a lot of people are predicting that we're going to see a rapid drop in mortgage rates quickly because of how fast mortgage rates have gone up. Well, if you look at what the Federal Reserve Bank is saying, they're saying now that they expect interest rates to stay around higher than expected for a longer period of time. In fact, this was actually the first time that the Federal Reserve Bank gave any predictions as to where they expect interest rates to be in 2026. Before yesterday, the furthest out that they gave for their interest rate predictions was into 2025. So yesterday we got the first prediction for 2026. Now, in addition to inflation and interest rates, the Federal Reserve Bank also gave a little bit of a talk about their predictions on the economic growth, and what they're thinking is that the United States economy will actually be growing faster than expected because of the resilient consumer that I talked about in the beginning of this video. What the Federal Reserve Bank is saying is that they're now expecting this year the United States economy to grow by 2.1%. That's more than double what they expected in June, meaning that they're expecting essentially the economy to grow faster than what they originally expected. And also they're saying that in 2024, they now expect the United States economy to grow by 1.5%. And recently they expected the economy in 2024 to grow by 1.1%. So what does that mean? Again, take every prediction with a grain of salt, but essentially what it says is they are upwardly revising their predictions on how fast the economy is growing. So they have a strong outlook on the economy. They think the interest rates are going to stay around higher than expected for longer. They think that these higher interest rates are going to have a lower impact on the economy, but a stronger impact on inflation. And they're also hoping that we will see some more loosening in the job market, aka higher unemployment. So hopefully that will help you understand kind of what the Federal Reserve Bank said and what they're looking for in the coming months and years. If you found this helpful, let me know, and hopefully we'll see you in market briefs as well.